We have the market open at our hands and it is a good opening. 22,000 has been scaled at least at open, but that was the case yesterday as well. The big question is if we sustain this rally, because the Nifty Bank is doing okay, 150 point gains, and I think the rates will populate for us on the screen as well, because some of the rates have seemed to be a bit hung up, because the Nifty Bank is actually above the 46,000 mark right now, and even the Nifty 50 is just around that 21,960. Let's quickly move on to the individual bets then. SJVN is one stock which is open with a gain of around 7%. Lupin was the big star that we are watching out for after the 5th consecutive beat. That too has opened up with a gain of around 4%. Cummins India was a very strong show, both in terms of the domestic volume as well as the margin improvement. That too has shown good growth. Yes Bank is a very curious case. Over the last 3 days, that stock has been inching higher. Again, it opens with a gap up of around 7%. If I have it right, over the last 1 week, we have seen a gain of almost 30 to 40% on this counter, so keep it on radar. LIC ahead of its earnings is up around 4%. IOB has opened with a gain of 4% after that gain of 20% yesterday. You also have Kalyan Jewellers after that big block deal which is in focus. On the losing side, Sobha is coming under stress because the earnings were weak. Borosil Renewables is not doing quite well as well because it's seeing a cut of around 7%. JK Paper, Piramal Pharma, Tata Consumers, these were some of the other names which are a weak result reaction, and even Fortis for that matter is showing a start on the back foot. ITC surprisingly is down about 1.25%. So watching out for that. Paradeep Phosphates as well as Mangalore Chemicals are the other names that we should pull up on the radar as well, given that big deal had happened and that was expected to show quite a bit of spike. So we have Mangalore Chemicals up around 10% and Paradeep Phosphates will come up for you on the screen as well. Supriya Life was also result reaction, 7% higher. Inox Wind, that 1500 megawatt tie-up is auguring well for them, so 5% gain. But overall, it's a lot more green, Avan, in the broader markets. Given the kind of momentum that we have seen, and even the small cap index and advanced decline ratio are tilting more on the positive side.
0.5% higher there. You're seeing pretty strong traction coming in for the mid and the small cap indices, and just going to mark then which are some of the individual movers within that space. I know you flagged off the newsmakers, but other than that, you've also got a Yes Bank that's scaled up, SJVN, First Source, Power Grid, for instance, IRB Infra, Walk Hard. Those are some of the buzzers on the upside. Let's get in our chartist view as well on the market open this morning. And Kunal, what is it that you make, or Naresh rather, what is it that you make of the market open? 22K, but it's pretty much touch and go at that level. And it's traction building up in the broader universe. Kunal, Naresh, you need to unmute yourself, please.
So that continues to be the trend. We hit new all-time highs on the Nifty 500 as well as the mid-cap and the small-cap indices now. But we are yet to see momentum on the large heavyweights. So the bias still remains positive, more focused on stocks. So the stock which I would like to go with right now is a buy on Muthoot Finance, where the stops are very small at 1400.
Naresh, what's your sense on Yes Bank, the kind of move that we are seeing? And we should also flag out Paytm because after being in upper circuit yesterday, it's down 7% ahead of the RBI MPC.
So Yes Bank looks like a sell clearly. If we look at the market cap today, it is around 85 to 90,000 crores. Pre the fiasco back in 2018, the peak market cap for the company was around 92,000 crores. So the stock price may look still at 30 bucks. But in terms of the market cap, it is closer to almost the same peak which it was at 400 rupees. So the huge recapitalization, etc. So, and it has the largest shareholders in India, almost 50 lakh shareholders. We've seen a lot of interest. So at current levels of 30, 32, there is not any upside left as such. Paytm again would wait it out for some clarity, would not like to catch a falling knife.
Thanks very much for that, Naresh. Vikas Khemani is now joining us, founder of Carnelian Asset Management. Vikas, morning. Thanks so much for your time. Vikas, I'd like to talk to today's discussion to start with defense space. I was looking slightly deeper, and one found that though, say, half a dozen of the top of the mind defense stocks may have run up a whole lot in the last few quarters, but one can divide the defense space into service providers around defense and the real manufacturing companies which are manufacturing deep tech, high value added kind of parts and the play, not only for domestic but overseas too. Which end of the defense are you bullish on? And do you think that the low-hanging fruit in defense may have gone, but one can still work around them?
I think Ajay, defense is no doubt a big opportunity, but given the nature of the opportunity, it is going to play out over a long period of time. The challenge in defense right now is that a lot of future growth, future opportunities are already factored into the pricing of many companies. Companies are trading, at a crazy valuation. So in that sense, one has to be very careful and cautious. And we have seen from our experiences in the past that while things look good, but growth don't come, in a just one way. It takes its own time. So there will be periods of consolidation. We have seen that in many sectors. Like I think chemical in 21 was like sector which could nothing go wrong. And 22 we saw correction happening. So I think while we believe in the long term opportunity, but there should be one should be very careful. One should have to look at on the company fundamental opportunity space it is operating into, it competitive intensity, and of course lastly the valuation of the company, right? So we look at all those things, and only if the risk reward makes sense one should buy. Otherwise one should be very careful.
Point taken, and you've been quite positive, Vikas, on the pharma space as well. Not sure of your bet on Loris, but at least Orchid Pharma has turned out really well, especially after that got the European approval as well. Within pharma, are you looking at expanding your presence?
We have a fairly large overweight on pharma. If I remember correctly, in different front, but we have like upwards of 20% weight in someone in pharma and API space. So I think we are very well positioned, and of course we keep looking at, never say no. We keep looking at opportunities all the time, and but yeah, we are quite bullish and optimistic and overweight in pharma as a basket.
When it comes to IT, would the preference tilt towards mid-cap IT versus the large caps?
Again, we really don't look at mid cap as a large cap. When we look at really the growth, and like we have discussed in the past, that in every cycle there are companies which go through a transitionary phase and become go into the next orbit. And I think this cycle also will have many companies which will go from small cap to mid cap to large cap. So our idea is to look at those companies which are well placed to get this transformation or transitionary phase where they can become big, and there could be mid caps in that, there could be small caps in that. Sector we are quite positive, and of course we have been quite heavy overweight on IT mid caps, but that's just I mean, we don't really decide based on the market cap criteria. Only we do decide based on the business model and the growth profile and the quality of the management of the company.
Vikas, you've been observing a lot of commentary lately coming out from our policy makers, be it finance minister at the budget. People have got into the habit of, or we are used to taking vote on account as a complete non-event. But there was two big surprises coming out. One was lower borrowing number, and of course fiscal deficit number, which did play a big part in this commentary. Then there's a question that we are, the government is now looking at the next generation of reforms. There has been a talk from the Prime Minister himself around it. What could those new generation reforms be in your view? We've seen slew of reforms already in the 9 years. Will we have more of the existing ones, or there could be some aces up their sleeve, new ones?
Sure, see, it's not that we have kind of done everything done and dusted. Right now, I think what has been done is to build strong foundational reforms without which we could not have even dreamt to achieve 6-7% growth. Whether that was a banking sector reform to RERA to IBC to tax reforms, I think all of them are in place. So they are kind of making things well. But I think if you ask me, judicial reform is a very big pending area, which I think has been wanting. If we want to become a global center, we need to have a judicial reform, which is quite pending for quite some time. Likewise, I think what we need to do on the skill training or skill development side, while there's a lot has been done, but I think we have miles to go on that. How do you make large population of the country productive and effective? So I think which I think also gets linked to the educational reform, which government has been talking about. There's a capacity building which needs to happen both in education and healthcare, and we might think that is a narrow focus on those segments, but they have a huge transformational impact on the overall productivity of the company. For example, I would give you the fast tag, which seemingly appears to be a very small reform, but it's a very big reform in terms of improving the logistics cost of the country, right? So we don't realize how small things have a large impact on the overall. Now, nobody would have kind of said park tag as a reform. But to my mind, it's a very big reform. It's a reform of mindset. It's a reform of, kind of taking smaller things and making a big impact. Same way, I think healthcare and education reforms are very big, looks like smaller reform and narrow reform, but they're actually very big overarching reform. So I think they will touch upon, in my opinion, building the capacity, improving the productivity. Of course, infrastructure, a lot of reforms are pending, and we need to build the next level of infrastructure, which it's underway, but I think it can be definitely be much more than what we need to be if we want to be, Viksit Bharat, and we need to have manufacturing picking up, if we need to have, $30 trillion GDP by, 2047. So all those things, in my opinion, you will see a lot more happening in next 5 years.
So yes, judicial reforms, the skilling part of it, of course, there is, we are wanting for more as far as the reforms are concerned. But because for the PSU pack as a whole, is there a FOMO feeling in terms of missing out, whether railways or whether, the PSU banks and OMCs for that matter as well?
I think FOMO feeling comes to guys who have not invested. We have been participating in PSU, so we've been invested, in PSU stocks, especially PSU banks. We own BHEL, we own HAL. So I think we participated, and we really don't look at anything as a PSU or non-PSU. We look at wherever there's a transformation happening, especially, we take care, and we like where there's a governance is in place, a business model is in place, and evaluations are in place. And in many of the PSUs, most people have missed out a very big change in the governance part. And people who looked at PSU governance with the historical lenses have missed out. And I still see a lot of investors, just reject PSU. No, we don't invest into PSU. The thing is that when the country is going transformation, the government's mindset is transformative in every area of this thing. When the Prime Minister himself has said, or in fact, why he has said, we can see, witness in the every action of them. They are giving freedom to the PSUs. They are giving enabling environment to the PSUs to go and make them, like in banking, all the CEOs of the banks, PSU banks, are given free environment. No more calls come from ministry to lend to somebody else. So they are being allowed to operate, independently. So that was a historical problem. So if it's happening, then why would any PSU bank trade at significant discount to any private sector bank? And our biggest call has been that this bridging of the gap will create biggest value. And still we don't find there's a huge, still there's a lot of value on the table if you look at in most of the PSU banks. So I think that's the job of an investor, to kind of look where market is not looking, but there's a big change happening. And I think PSU still is, looking good.
Thanks so much, Vikas, for joining in and sharing with us your outlook, the sectoral preference, and of course the criteria to looking at investments in this market.
Thank you very
22,003 is where we're at. It's the broader end of the market that's really stealing the show, and there's names like Power Grid, BPCL, Indices Bank, and HCL Technologies at the top of the heap. But let's put the spotlight on Tata Consumer Products. Sunil D'Souza, the Managing Director and CEO, in conversation with Nikunj, talking a little bit about the earnings fine print.
Well, when you have Sunil D'Souza on the show, you have lots of things to talk about. Quarterly numbers, big acquisition, what is happening in rural India, and which is the new innovative product line Tata Consumer is coming with. So, Mr. D'Souza, good morning. Thank you for joining us. What should we start with? There are lots of things this time.
I would say the thing to start with is the quarterly results. I think we delivered a decent set of results. 9% top line, 26% EBITDA growth, and 31% if I take off the one-off, which is charge relating to some 20-25 years back. 31% growth on EBITDA, on group net profit. Volume growth across the businesses. Tea, foods was strong. International has come back to the party, 11% top line growth. Our growth businesses keep on firing, overall a 42% growth, and all the businesses are plus 40 now. EBITDA margins are now north of 15. Working capital down 7 days. We actually generated 40% more cash in Q3 this year versus Q3 last year. Close to 3,000 crores of cash was sitting on our balance sheet, and I say was because we're going to use it now for the acquisitions. The other thing, Nikunj, I'll take it up front, your favorite topic of ROC, 260 bips up year on year. So that is something which we keep on watching. Market shares overall, while if you take the MAT numbers slightly softer, we hit record salt shares in December, all-time highs. close to 39 plus now in value terms. Quarter on quarter, beverage shares are up. In fact, we've gained close to 30 bips on volume. Our closest competitor has lost 30. Distribution on track, 4 million outlets now, numeric reach. Innovation, like you mentioned, is now 5.3% this quarter versus 3% last year. So all in all, business firing on all cylinders. And more importantly, we are adding new engines of growth with Capital Foods and organic.
Okay, I'll come to specifics of the acquisition, but one concern which everyone, it's not a concern, but it's an observation, which is that you're losing market share in your tea business, and that decline has continued for the 5th quarter on the trot now. Is that a conscious move?
So Nikunj, actually speaking, we quote the moving annual total, right? So it's a sum total of the last 12 months. And that's why I said, if you look at the last 12 months, it is a negative 68 bips, 0.68%. But if you look at quarter on quarter, in value, we've gained 16 bips. But more importantly, volume, we've outgrown our competitor. We've grown by 30 bips versus competition, which has lost 30 bips. So not too worried out there. It's a basic question of execution. And our focus on growing the premium end of the teas is coming back. So the mix is very strong. The Indian beverage business is now, gross margins are up by 500 bips. So on a very strong wicket. I wouldn't be overtly worried. We've just got to get execution done behind our plans.
Okay. The acquisition, which in a sense has got everyone talking and thinking, for a company which in a sense was really growing organically, has taken a big leap forward. What was the thought behind it?
So Nikunj, we've always maintained that we want to be a premier FMCG company. And in the premium FMCG company, we said we will first focus on growing our food and beverage business before we venture into the broader FMCG. So these moves are part of our growth into the larger FMCG business, so to speak. 3 years back, or 4 years back, when we started our journey, we had mapped out the entire food and beverage universe. And you have to remember, we started life as a tea and salt company, effectively, which are basically commodities. So one of the big thrusts was to get into value-added foods and beverages. And when we looked at the landscape and what we could do organically, we had mapped that out, and that's why you see our innovation numbers very strong as we expand in the categories or the brands that we have and we play with. But then we also said we will grow both organically and inorganically. And when both these assets came into the market, when we evaluated them, we figured, given the fact that we have a strong S&D system, given the fact that we built a strong R&D, digital infrastructure backbone at the back, and the fact that we have a global footprint, we calculated the value that we could generate. Capital Foods, hats off to Ajay Gupta and his entire team for having built a very, very strong brand with Ching's. Literally market leaders, number 1, number 2 positions in all the categories that they operate. I think it gives us a platform to rapidly expand into the food, value-added food space, if I may. Organic India, very, very strong back end. One of the biggest things, we spent the maximum amount of time understanding the fact that it was really organic. Once we convinced ourselves of that, then we looked at the portfolio. Herbal supplements, a trend across the globe. Not only in India, but we've got opportunities to grow outside India. Organic foods per se is a trend which is catching on. These people have fantastic products. They were just limited by distribution, so to speak, 24,000 outlets. So we thought we could really multiply it. So we've got the base infrastructure on which we'll plug on these platforms. There is significant amount of cost that we can take out in the middle of the P&L, apart from the fact that we'll grow top line at significantly higher levels than where they are today. So all in all, fulfills a very small portion of our ambitions, so to speak, towards becoming a large premier FMCG company.
This acquisition would be funded via internal cash, which is there on your balance sheet, and also right issue. So I'm assuming in this case, the promoter, which is Tata Sons, they would be participating and their holding post the right issue could go higher?
Right now, Nikunj, we've said we're going to utilize the significant amount of cash lying on our balance sheet, and we've announced a rights issue of 3,500 crores. yeah, the promoter does back up saying that they will subscribe to any unsubscribed portion of the rights issue per se. So one step at a time. Right now, that is what we've announced.
And when you see the right issue will be announced?
Yeah. So we've already got approval from the board. We've already started working towards the rights issue. I think overall within, I would say about 4 months or so, we should be coming out in the market.
3 years out, Mr. D'Souza, once the acquisition integration would be on, I mean about 18 months to 24 months is the minimum time you would require to look at integration, supply chain, distribution. What will happen post that to my favorite number, which I always ask you, return ratios? I'm phrasing it differently this time so that you cannot preempt it.
No, so Nikunj, let me say, actually Capital Foods, we had the final closing board meeting on the 1st, and we started invoicing on the first evening. We've already finished a substantial part of the front-end integration. By February 15th, we should be done and dusted. In the next, I would say probably 70, 80 days or so, we will finish the organization integration as well as the back end. So within 100 days, we should be done. Organic India, we expect to close sometime in March, I would say. And again, the target would be to finish integration within 100 days. The reason why, A, is we quickly remove any uncertainties that are lingering around in both sides, our organization, their organization, number one. The go forward is clear and we get to executing plans. So we do aim to start creating value very quickly, number one. Number two, return ratios absolutely focused on. As I said, we are 260 bips up in this quarter versus same quarter last year. So that keeps on inching up. So the base business, we would continue to increase ROC, but of course, as we grow, as it requires capital, we are building a platform for the future. But from wherever we are, there will be a target of significant increasing of ROC numbers.
No, but because you've acquired what is a premium food business, and the Organic India business also is a very high margin business, it's a very niche business but high margin business, on a blended basis, if this acquisition, what would be your return ratios? And two scenarios here, sir. Imagine a scenario where these acquisitions would have not happened. Then what would have been the linear growth for return ratios? And post this acquisition, what will change in terms of return ratios?
So Nikunj, first I'll talk about the return ratios without those businesses per se, and that's why I alluded to our EBITDA now being north of 15%. Remember when we started off 4 years back, we were in the 11, 12 sort of number. We've come to a 15% plus while growing top line, I would say almost best in class in the FMCG space currently. And we are in touching distance of some of our close competitors who are considered good operators in the Indian FMCG business on EBITDA percentage numbers. So that's where we brought the base business per se. Very, very conscious that as we bolt on acquisitions, we need to make sure that the overall return ratios need to continue to grow. We do think we can create substantial value. And while we do that, we calculate IRRs for all the acquisitions, and they pass all muster with our board in terms of the targets they've set, which again, the board is very, very conscious of ROC. So I would say incremental top line, but more importantly, significantly incremental bottom line, precisely because of what you said, high, very, very high gross margin products.
You know, when I asked you last time that are you on course to beat Morgan Stanley estimates, and I referred to that number publicly. Now that question was asked before the acquisition. So what do you have to say to latest take from Morgan Stanley?
So all I would say is, Nikunj, we remain focused on driving execution, making sure we provide best returns to our shareholders. My team continues to focus on top line, making sure bottom line grows faster than that, so that on the given capital invested base, we continue to improve.
For your existing portfolio, can I say inflation plus 2% or 3% is the kind of growth which is now the base number? That's the bare minimum at which your existing portfolio will grow?
Nikunj, all I would say, if I grow at that rate, then we've not done justice to the faith reposed in us by the board and the shareholders. So I'll split it into two different pieces. One is our tea and salt business, and one is the growth businesses. The tea and salt businesses, you're absolutely right. We've always guided for volume growth in the mid-single digits and a couple of basis points on top of that to take us to high single digits on overall revenue growth. But the big part of our business is the growth businesses, which this quarter again have grown 40%. These businesses now contribute to roughly 17-18% of the India business per se. And I would dare say we would exit the year close to a 19-20 contribution. That is growing at 40%. On top of that, we're bolting on our capital foods and organic. So as part of the growth engine. So I would say high single digits, low double digits would be the bare minimum for us.
Okay, so I'll ask a couple of questions, just maybe last but one question. I'll be specific here. When do you think you would be able to go to 20% operating profit margins for your new acquisitions, which is Capital Foods and Organic India?
If I take it off separately, Nikunj, and if I by operating margins, I would take EBITDA percentages as the norm. I would say Capital Foods will get there very quickly. Organic India, I would say 3, 6, maximum 9 months. 20% plus EBITDA, not a difficult piece. And the reason I say this is because, as I said, in the synergies that we've calculated, there is substantial amount of cost takeout that we can do given the scale that we operate in. So not a very difficult proposition. That I would say is par for the course. The game is how much more can I add on top of that?
Okay. So in terms of growth business, I'm assuming that this is the growth business category which you've always categorized for us, which would also include, let's say, the entire portfolio of, Nourishco, the protein portfolio. How much total contribution will come from growth businesses for Tata Consumer in FY25 and beyond?
So Nikunj, we've said, we've always guided saying we will grow our current growth businesses at a 30%. I think when we put out our acquisition numbers, we said we aim to take the contribution of growth businesses from 20% today, which is growing at 30%, to 30% very quickly, continuing to grow at 30%.
Okay. Mr. D'Souza, Street is really divided. Some are confused and there are conflicting data points on rural economy. Now, HUL is saying that volume growth is not there. Motorcycle companies are saying that, look, we have a problem in terms of what is happening to two-wheeler sales. But if I look at data points, which is, let's say, coming from an Tata Consumer, or which is coming from an Marico, or which is coming from your V-Mart, the data is very different. What is the right way of looking at rural consumption demand?
So Nikunj, I would say I would not compare myself with the other companies for the simple reason that my distribution opportunity and share opportunity that lies in rural, which is, I would go one step further and say semi-urban and rural, which is where my weak numbers are. That is where I have to gain. So my growths are coming from these geographies, but just with the rider saying that we were weaker and therefore we are gaining in those geographies. Overall, from what I hear, what I see on the ground in my market visits, my salespeople telling me, etc., rural demand seems to have stabilized and seems to be coming back, albeit it is not at the levels where it was pre-COVID. But I do remain hopeful given the fact that we had a fairly decent monsoon. We've got an election season, and therefore I would expect a little bit of more spending in the economies going forward. And from all forecasts that we see right now, it's going to be a normal monsoon. So I remain hopeful that we'll see rural demand coming back strongly.
Mr. D'Souza, 15 minutes into today's conversation, we've not spoken about inflation concerns. Now, if inflation is speaking out, that technically will have an impact on volume growth per se, because the price hike FMCG companies are taking. Now, if inflation is stable, what happens to the price hike and the volume growth, which is also a function of how price hikes are taken?
So Nikunj, broadly in our portfolio, whether it is the base commodities that we use or the input items that we use, we see broadly benign inflation, whether it is tea, whether it is salt, almost stable pricing in India. Coffee is a bit of a volatile commodity right now, both in India and international. That is something we got to tackle. a slightly smaller part of my portfolio. Oil is benign, so therefore the downstream inflation we don't expect to be too much. Broadly benign costs. Now, if costs are benign, we've taken all the I would say price increases to put margins in the right place. And I do think overall, whether it is India tea, India salt, or my international businesses, gross margins are broadly where we want them to be. Now the game would be volume growth. And we are seeing volume growth. For example, even in salt, where now we've roughly for a significant amount of time, we've not taken any price increases. We've seen volume growth of 5%. That is where we want it to be. So it's broadly come back to normal. In tea, we have seen 4 successive quarters of volume growth. So broadly, the game will now be focused on volume, given that costs are benign.
So final question, Mr. D'Souza. If I put the numbers, acquisition strategy, contribution coming from growth business, market share gain, volume growth, will I be conservative if I say that in every 2 to 2.5 years, Tata Consumer has potential and aspirational to double its turnover?
I wouldn't exactly comment on that particular thing. Nikunj, all I'd say is double-digit growth, continuing gain on market share, and delivering bottom line, which is faster than top line growth.
But as someone who's tracked Tata Consumer, if I'm putting my numbers together, am I thinking right? Just give me a hint.
We would be targeting very, very aggressive growth numbers. But again, I would say profitable growth. Margins have to continue to expand.
Which means profit has potential to double in 3 years.
We've not done the math exactly that way, Nikunj, but yeah, aggressive numbers.
All right, sir. Really appreciate your time. Thank you so very much.
Thank you, Nikunj. Thank you.
Okay, so that was Tata Consumer in focus. Quite bullish about their growth, but the focus really stays on profitability as well. A lot of big movers in the trading session, so let's spot some of those. Take a look at New India Assurance and GIC. Those stocks are actually firing up. They're up around 10% if I have it right. So yes, 10 to 12% gain on both those counters. Overnight, we did get the life insurance and the general insurance monthly update. So that could be one of the triggers. And the earnings from GIC also came, though the numbers don't look very impressive to me. Yes, on a 9-month basis, there has been a bit of a growth. But if you look at it on a year-on-year basis, the profitability has come in at 1,500 odd crores versus 1,100 crores or 1,200 crores last quarter. Separately, Power Grid. I'm a bit surprised with the numbers, with the reaction there, because it was pretty much a inline set of numbers. And let's pull up the intraday chart if we can of Power Grid, because that stock is up 7%. There was no blockbuster in the number. And of course, the con call is today with respect to the capex lined up, but clearly excited on that one. But JB Chemicals is the other stock on our radar. Mr. Nikhil Chopra, the CEO and whole-time director, joins us on the show for JB Pharma. Thanks so much for making time and speaking with us. Nikhil, good to have you on the show. Let's begin by discussing your earnings. First up, overall, what kind of scenario do you see on the ground with respect to the kind of demand scenario which is building up and the orders which we are getting?
First of all, good morning and thank you for having me on the show. It has been a fair run for JB for 9 months of the year, if I have to share, and the demand has been also good. Overall, if I have more in the chronic part of the business, where we have been excelling, and within chronic part of the business, our forte remains in the field of cardiology. So we have been working to raise the demand, not only by going in the clinic of doctor, but also looking at how do you reduce the burden of disease, how do you overall look at the entire ecosystem, drive better adherence for the patients who are taking the medicines. So it's a holistic approach that we are putting at JB in any therapeutic segments that we get into. First 9 months of the year, we have been growing at 10%. EBITDA and profits have been growing at 20%. It has been a fair run. And majorly the contribution is coming from India business, which is contributing 53% to the revenue. We declared our results, 845 crores for Q3. The revenue grew at 7%. And our EBITDA was close to 235 crore, which grew at 22% plus. That is where we stand. Equally, international business is also doing fairly well. 9 months of the year, we have been growing at 7%. Our emerging market, that is ROW market formulation business and CDMO business, has been performing well, and the demand continues to be there.
Nikhil, we can see that what a strong growth you're posting in your India business, and that's more than 50% of your revenue. So barely any growth in export is also getting made up for. But I want to understand profitability. Where is the 27% margin coming from? And where would you like it to sustain from here on?
The highlight for this quarter is the gross margin that we could score, which was 67% plus. It has been put in place in a designed way. If I have to share, a lot of efforts have been put in terms of how do we improve the mix of the business, particularly in India, where the chronic part of the business is overall improving its contribution. There is a robust efficiency program that we run in the company where we look at productivity enhancement across the company, whether it is for our employees on the field in terms of productivity, whether it is at our manufacturing sites, whether it is better vendor management, and equally tilting more towards the entire CDMO part of the business, which we do outside India. There also we have better margins and better volumes, which is overall helping us. And last but not the least is the haircut that we have taken in our South Africa business, where we are now less participating in tender market where the margins were thin. So that is overall also helping us in terms of where we are from gross margins and EBITDA margins.
Right. Morning, Nikhil. Wanted to also get in a sense as to what the outlook is in terms of your ophthalmology segment, because I believe that also holds great promise down the line. In terms of contribution, how are you looking at that and what kind of opportunities do you foresee?
So it has been a good addition to the portfolio, which we could do. And very early for me to share about what we are trying to do in the world of ophthalmology, but it's a licensing income. It's a license income for distribution and marketing agreement with Novartis, where we are working closely with them. And we have acquired 10 brands, and out of those 10 brands, 5 brands are number 1 in their category. We are majorly into glaucoma, NSAID's anti-allergic portfolio. This is a 200 crore portfolio, and the way next 3 months we are using in terms of getting to know more in the world of ophthalmology. Probably I'll be able to throw more color in post Q4 results. But it's an exciting journey, and ophthalmology overall as a segment is outscoring the IPM market. So we are once again in lieu with our entire hypothesis of getting into the growth market. This ophthalmology deal also helps us in terms of taking JB's journey ahead.
And we'll love to hear more about it after Q4, as you pointed out. But you're pretty much on track for your guidance for FY24. But of course, the focus now shifts to FY25. Do you think 12 to 14% growth with a 16 to 18% EBITDA growth is a bit conservative?
If you look at overall the way JB has been performing, if you look at the way we see overall the way India market growing, India market should grow. Overall, I'm talking of Indian pharma market. It should grow at around 10%. We should be growing at around 200 to 300 bips better than the market. And the way geopolitical issues are there overall happening in the international markets, we have kept our guidance of international market growing at double digit, that is around 10 to 12%. That is how we have guided 12 to 14% top line growth and 16 to 18% EBITDA growth, which will overall help us to improve our rankings, to improve our prescription share, and to serve more and more number of patients. And the journey at JB is only upwards and onwards.
Yes, Nikhil, great chatting. Thanks so much for your time this morning. That's the journey of JB, which Nikhil is indicating towards the smile is upwards and onwards. So you can understand where the stock would be heading in the long term. We'll take a short break. On that note, come back and full tilt on policy. Nothing major expected on the rate front, but do watch out for commentary, and top line of experts will be joining us.